Hi, I'm James Robinson, and this is my stock pick of the week. This is the fourth in my series of videos on Intel. This time we're going to look at the company's dividends. When looking at the company's dividends, I think it's more important just to say, what's the yield? How much money are we making? I think we want to get a sense for context. How much money are we making, and what is the trend? Is this company continuing to raise their dividends? Are the dividends flat? Are the dividends going down? Secondly, I like to look at safety. How comfortable am I that this company is going to be able to continue paying dividends going forward? So we've got some metrics that allow us to look at those things, and so that's what really this video is about. The first thing that I look at when looking at dividends is the amount of dividends that are actually paid. That's not dividends per share, that's the amount of total dollars that the company is committing to pay dividends. I like to see that number increasing. Sometimes what you'll see is the dividends are relatively flat, but the company is buying back shares, and so the amount of money they're paying in dividends is paid out over a smaller and smaller share base, and so it looks like the dividends are increasing. That's fine too, but it's not as good. It's not as solid an indication as a company who's generally putting more and more money to work every year for the shareholders. So when you see this company, again, you'll see the company paid just under $6 billion in dividends last year. That's wonderful. Dividends have gone up every year except one. That's also wonderful. Dividends in terms of total amount paid have gone up every year except one, and in fact have gone up every year in dividends per share. The dividends per share chart is steeper than the dividends, generally the total amount of dividends dollars paid chart, and that's again because the company has been buying back shares, and so they're taking an amount of money, it's being spread over a smaller number of shares, and so the number's going up disproportionate to the amount of money the company's spending. So long story short, this company's done a great job with dividends. Looking at these two charts, if I was a retiree, for example, and I bought shares in Intel, I'd be comfortable that not only is the company going to increase my shares, I'm going to get a raise every year, right? My retirement income is going to increase every year if I've got some of my money in Intel stock. And when I look at dividends, I'm not a big dividend investor. I don't choose companies because of dividends. If I had a choice between two companies, I would probably choose the one that's paying higher dividends. But generally speaking, it's sort of a non-issue to me. I plan on owning these companies and building wealth. I'm not yet in the retirement area of my career, so I just want to do what I think is going to be the most solid investment. But companies that pay solid dividends and are able to raise those dividends over time tend to perform better as stocks, and so I give them the nod. But if all things were equal and I had a company that was getting a 15% return on reinvested money on retained earnings, if I had a company doing that, I wouldn't want them to pay any dividends, and I wouldn't want to buy back any stock. I'd want them to retain all that money, put it back to work, and get me 15% compounding, right? So it's not as important to me as return on retained earnings, for example, or return on assets. Those are more important numbers to me than dividends, but a lot of people are dividend investors, and so for those people, I do this additional research. So what additional research do I do when looking at dividends? Well, I look at four factors. Obviously, I look at yield and growth. Then I look at dividend safety in the context of earnings. And what I'm really doing here is saying, if a company's paying out 101% of their earnings every year in dividends, that's completely unsustainable. Sooner or later, the company's going to run out of money and not be able to pay those dividends. If the company's paying 80% or 90% of their earnings in dividends, then I am pretty nervous that company is going to continue to build their operations and have reserves paying that much of their money to shareholders. So there'd have to be some special circumstances before I'd look at a company like that. And by the way, one of those special circumstances is a REIT, which by law has to pay 90% of their earnings as dividends. But generally speaking, what I'm looking for is a range. We'll talk more about that as the slide comes up. Then I look at dividend safety in the context of cash flow, sort of the same thing, but cash flow is a more granular look at a company's ability to pay their dividends, because cash flow, you can't hide anything in cash flow. It's money in and money out. And what percentage of the net money in is the company paying us, again, is the level of the sustainability of that dividend. Finally, I look at dividend safety in the context of its current debt load. So the idea here is as interest rates were to go up, which they almost sooner or later they have to, right? If interest rates were to go up, how much would that increase in interest rates affect the company's ability to pay debt or pay dividends? Now, if you think about it, if the company has a tremendous amount of debt at low interest rates and those interest rates go up, then that debt is going to increase the interest payments, which is going to reduce the amount of money available to the shareholders to pay dividends. And at some point, it might make it impossible for the company to pay dividends. So debt is one of the things that we look at in terms of a measure of the company's ability to pay to continue to pay dividends, and thus the safety of the dividend. So in this chart, the blue line is the amount of money that the company is paying in dividends, and the red bars are the percentage increase each year. So the company's yield is 2.8%. So I've just updated the numbers for 2021. For 2020, the S&P 500 paid 1.57% in dividends. That's the average company. It's if you bought the entire portfolio of the S&P 500, all 500 companies. This company paid 2.8% in dividends, so almost twice what the S&P paid. That's wonderful. If you're a dividend investor, this would be considered a reasonably high payer, especially in light of the safety of the company. More importantly, or at least just as importantly, the company's average growth over the last 7 years has been 5%. Over the last 5 years has been 7%. So it's growing. The company's dividend is growing at twice the rate of inflation. So if you put just enough money in the bank to retire into 100% into Intel, as an intellectual enterprise, then every year you'd get about a 7% raise. Since inflation is going up at 2 or 3%, your retirement income would get better and better every year. You'd get significantly more money to spend every year as a result of that investment. So the yield and growth for Intel is very, very solid. It's a wonderful dividend payer, and it's a stock that if I was a dividend investor, I would consider having in my portfolio, because it's a reasonably good dividend, not spectacular, but reasonably good. It's growing at a great rate, and the company is pretty safe. The next thing that we look at is the sustainability of the dividend, and we measure that as the payout ratio, which is the amount of income the company pays out to its shareholders as dividends. The average payout ratio of the S&P 500 is around 40%. This company is at 26.8%. So this company is paying out significantly less than the typical company that based on its earnings, which means that it's very, very safe. I actually would like to see this number increase with Intel, believe it or not. But part of that is because the companies the last couple of years 2018 17, 18 were exceptionally good years. I think this actually should say 2018 and 19. I think that might be a typo. But they were very good years for the company. And so when a company has these really explosive years, they don't want to go crazy with the dividend, because then they have to raise that going forward, and that might make the bogey harder and harder to hit. But generally speaking, this company has been as high as 55%. Again, that's a little high. So in average, the company is 39.6%. So for the last 5 years, the average payout ratio is almost completely in line with the S&P 500, which means that I think it's a very sustainable amount of payout ratio, and means that I don't have any concerns about this company's ongoing ability to pay us our dividends. Next, we use the exact same equation, but rather than using the income statement, which again, the income statement can be foggy in terms of its real value, because companies can fudge the books a little bit and do goofy things, accounting tricks. But with cash flow, they really can't. Cash flow is simply how much money came in and how much money came out. So to look at this, let's look at 2019. The company had cash from operating activities, that's money that came in as a result of operating, of $33 billion. They had capital expenditures, that's money that they spent on operations, of $16 billion. So the net result is free cash flow, which is money that the company can use for whatever it wants, of $16 billion. And therefore the company paid dividends of $5.5 billion, which means that they had a payout of dividend payout of free cash flow of 32.9%. The average for the last 5 years has been 40.3%. So those are very solid numbers. Anything under 50%, I'm very comfortable, is sustainable in this way. And so when I look down the context of cash flow, again, we get the full marks for this company in terms of its dividends. This is our final slide on dividends for Intel. What we're looking at here is the effect of higher and higher interest rates on the company's ability to pay dividends. So one of the problems with the company having a lot of debt is that they have to pay interest back to their lenders. And The next problem is that interest rates they move over time, and they're at all-time lows right now. So they're not likely to go down, they're likely to go up. And should they go up, how would that impact the company's ability to pay dividends to us, the shareholders? In effect, they're paying the bank the interest, higher and higher interest rates, instead of paying us, the shareholders, sometimes. So I like to keep an eye on that. So what we've done here is on the one side, on the very left side, it says interest rate, and interest rates going from 4 to 20%. It's hard to believe today, but in my lifetime, in the 80s, the early 80s, interest rates are almost 20%. And so it's not unreasonable to want to know what would happen if interest rates got back to that point. So the first thing is we say, okay, at some interest rate, what would that change our company's reduction in cash flow, because the company would have more money to pay debt and thus less money to pay its shareholders. So at 4%, there'd be an extra $1 billion that the company would have to pay in cash or pay in interest payments. And at 20%, they'd have to pay $5 billion more in interest than they currently pay. So that would change the adjusted cash flow, which is the current cash flow they have is about $16 billion. But after this adjusted increase at 4%, they'd have only $15 billion to pay dividends. And at 20%, they'd have $11 billion left from which to pay dividends. The company pays about $5.5 billion a year in dividends. So that means the free cash flow minus dividends would be about $10 billion at 4% and be about $6 billion at 20%. So the dividend payout ratio from cash flow is 34%, which is very, very good. At 4%, and is still even 46% at 20%. And again, I think if you remember from my previous slide, I don't have a problem with a company that is paying 50% of their adjusted free cash flow to shareholders. So they're still below that threshold, even if interest rates go to 20%. So that's a very long explanation for basically saying the company's debt is not a problem, not likely to be a problem at its current levels, almost regardless of what happens to interest rates. So the company is very, very solid. So the dividend is paying 2.8%. That's really, really good. It's going up at 7% a year. That's even better. The company has no problem paying. The company's payout ratio is very, very good and has been above average for the last 5 years. Same thing with dividends as a result of related to cash flow. And finally, the interest payment does not seem like it's going to be a problem with our company's ability to pay dividends. So I'd rate the company's ability to pay dividends for Intel as being extremely, extremely solid. And as a dividend investor, I would consider putting this in my portfolio. Thank you very much for watching.